What a difference a year makes. Powell made his announcement earlier today, and while the Fed doesn't believe there's going to be a recession, and I'm not so sure I believe them, they did raise the federal funds rate as predicted by 0.25% in order to continue slowing the economy down. Many economists predict, and I'm certainly hoping, that this will be the last rate hike and inflation is going to continue to come down enough to get the Feds off of our backs. So if you've been tracking inflation today, core CPI, the Consumer Price Index, came in at 2.97%, down from 4.05% last month and 9.06% last year. We learned that the Fed wants inflation to come down to 2%, so we're getting closer. Keep in mind that the Fed is not focusing on the typically tracked headline inflation. Rather, they're tracking core inflation. Core inflation tracks the change in the cost of goods and services, but it doesn't include the change in food and energy costs, which are included in headline inflation. So if you're trying to track when inflation is coming down, track core CPI. Secondly, Powell believes that we need to soften the labor market for core inflation to really come down. So if you're looking for lower mortgage rates, pay attention to core CPI and pay attention to unemployment. As those two indicators go in the right direction, we'll see lower mortgage rates. So for those who are buying today, here are the nationwide average interest rates. And remember, these rates are just a ballpark. Give us or your lender a call so you can get an accurate quote, as everybody's situation is going to be a little bit different. Now, before I let you go, let me know in the comments below when you think we're finally going to see no more hikes.